Hey there and welcome. Today we're jumping into a really cool option strategy that absolutely loves it when the market gets dramatic. It's called the Reverse Iron Condor, and it's your go-to play for when you expect some serious fireworks, but you're just not sure which way they're going to fly. You ever get that feeling? You're looking at the charts, you see the news, and you just know the market is about to make a huge move. But which way? Up or down? It's that classic trader's dilemma, right? Just picture it. A huge earnings announcement is coming up for a stock you follow. Or maybe some major economic data is about to be released. You can just feel the tension in the market building. You're expecting a price explosion, but trying to guess if it'll launch upwards or crater downwards, well, it feels like a total coin flip. But what if you didn't have to guess? Seriously. What if there was a way to bet on the size of the move itself and not have to worry about the direction? That's exactly the idea we're going to unpack right now. And that tool, my friends, is the Reverse Iron Condor. Think of it as a specialized piece of equipment designed for exactly these high-stakes moments, when you're confident about a big move, but the direction is a complete mystery. So what is this thing, really? Simply put, it's a four-legged option strategy that's built to make money if a stock makes a big move, and I mean either up or down. The two most important words to remember here are defined risk, which means you know your max loss before you even click the button, and direction neutral, which means you can stop trying to predict the future. All right, so how do you actually build one of these? I know, it might sound a little complicated with 4 parts, but it's really just putting together 4 options contracts that all work as a team. Let's walk through it step by step. So what you're doing is creating 2 pairs of options, what traders call spreads. First, for the downside, you buy a put option that's out of the money. That's your bet on a big drop. Now, to help cover that cost, you sell another put option even further down. Then, you just do the exact same thing on the upside. You buy an out-of-the-money call, and you sell another call even higher up. You're basically boxing in the current price and betting that it's going to break out of that box in a big way. Now, because the options you're buying are closer to the stock's current price, they're naturally a bit more expensive than the ones you're selling further out. This means you're going to pay a small amount to open the entire position. This upfront cost has a name. It's your net debit. And trust me, that little number is the key to understanding your entire risk in the trade. And why is that net debit so important? Well, because it single-handedly defines your entire risk and reward profile for the trade. So let's dig in and see exactly what you can make and, just as importantly, what you stand to lose. And here's the really elegant thing about this strategy. It's completely symmetrical. Both your potential profit and your potential loss are capped. They're limited. Your max profit is just the width between your strike prices, minus that initial debit you paid. And your maximum loss? Okay, this is the part you're really gonna love. Let's just let that sink in for a second. Your maximum possible loss on this trade is only the net debit you paid to get in. That's it, full stop. If the stock just sits there and does absolutely nothing, you know exactly what's at stake, and it's never a penny more. That's the power of a defined risk strategy. This table really lays it all out perfectly. If the price explodes upward or crashes downward past your break-even points, you're looking at your maximum profit. That's the win condition. But if the stock just sits there trading sideways, stuck in that middle zone between your inner strikes, that's when you hit your maximum loss. So the key takeaway? This strategy only loses money if the market gets boring. Okay, so this all sounds pretty useful, right? But the really crucial point is, when do you pull this strategy out of your toolbox? Because it's definitely not for every market situation. It has a very, very specific job. So let's quickly recap the main points. This is your tool for high volatility events. Like we said, think earnings or major news. It's direction neutral, so you can stop guessing. You've got that amazing comfort of knowing your exact risk and reward from the second you enter the trade. But, and I can't stress this enough, the stock has to make a big move. A tiny wiggle just won't cut it. You need real fireworks for this to pay off. So next time you're looking at the calendar and you see a big, potentially market-moving event on the horizon, maybe the question you should be asking yourself isn't just up or down. Maybe it should be, is it going to move a lot? Because if the answer is yes, you've now got a powerful new answer to that question.